Check out the healthcare sector over the past month. It's up better than 5%. Our next guest says this is the top defensive play to make in this current environment. Joining us now, Citi Global Wealth Head of North America Investments, Kristen here at Post Nights. Good to see you in person here.
Good to see you, too.
So I kind of feel like everybody now loves healthcare, the way that everybody loved energy, and then ultimately it got a little crowded and then the bottom fell out. Why is there still some room here to go in healthcare?
So this is something that we've been investing in. Actually, we started Q3, Q4 of last year. So we shifted our portfolios away from some of the hyper-growth stocks into quality across the board. So when you're thinking about quality, it's like the dividend aristocrats. Quality dividend growers, strong earnings, strong balance sheets. And so healthcare is a very defensive play. So we think that there's room to run in terms of you're looking at strong yields. And you're also looking at one of the only sectors that has been able to consistently grow earnings through the past 3 recessions.
Is this an expression of your overall market view? It's just how you want to play the defensive, right?
We want to be defensive
right now?
Yeah, we want to be defensive. And here's the thing is when you look at how the market has been behaving, we expect continued volatility. Unfortunately, that's what we expect. And we're not going to get clarity as to whether or not we're going to tip over into a recession for the next couple of months. And the reason that's important is that recessionary bear markets behave very differently than non-recessionary bear markets. Non-recessionary bear markets, we've done the damage. They see average drawdowns of about 23 to 25% and a duration of about 200 days. If you tip over into a recession, you see drawdowns in excess of 30% and a duration of around 400 days.
What if we're already in a recession, as some literally suggest we are, and the Fed knows this, and you're going to have a topped-out inflation report this time, we think, and all of that's going to force the Fed to not be as aggressive as we once thought?
I think one of the challenges that we have right now is what we thought could have been a Q3 resolution is now getting pushed out into Q4. Chair Powell, a couple weeks ago, was very clear on one of the mistakes that the Fed made is that they reacted too quickly to the data, that they saw one print and they decided that, OK, maybe inflation is transitory. What Chair Powell said is we need to pay attention to trends. So seeing what happened today is only actually going to encourage them with the 75 basis points. And then come September, are we going to really get any data that would pivot them away or pull back from that trajectory?
Yeah, our Steve Leisman has made the same good point. Restart the clock from today, right? Last CPI print you thought was going to be the top, wasn't. This CPI print you thought was going to be the top, wasn't. So now you have to start the count all over again.
Exactly. And then it really comes down to how are you positioned, right? So you want to be positioned for these two different outcomes. You want to be positioned for what could be called resilient, which is just slowing growth and seeing a reduction in earnings growth, or a recession. And that is why it sounds very simple, but both in terms of our equity positioning as well as our fixed income positioning, we're invested in quality.
What would you avoid most of all?
Right now, what would I avoid most of all? I think market timing, to be honest. When you think of what is the biggest mistake you could make in these types of markets, this idea that you're going to be able to call bottoms or get out when we see some of these market rallies, we see a lot of people doing that, either sitting on the sidelines thinking that they're going to be able to call that bottom and seeing inflation really kind of erode the value of that cash, or we see people getting out, basically deciding that they can't take it anymore and they don't get back in.
But
so
what about
avoid that temptation.
What about like a sector type conversation on that same question? If you're a longer-term investor, the kinds of which you're obviously advising in a global wealth role, would you buy large-cap tech here, for example, or not?
I think there's an opportunity for a long-term investor to buy large-cap tech. So when you see some of the sell-off that's occurred, I would stay away from the hyper-growth. I would stay from areas that are not profitable. But one of the areas where we're investing in tech is cybersecurity. So take a look at that particular subsector. It's off about 20%. We've seen some pullbacks. But when you actually look at their business models, their earnings, it hasn't pulled back really at all. There's no material difference. That's also an area of durable demand. And when you look at the indices, only around 9% of those companies are not profitable. So when you buy market capitalization, so you have some good, strong profitability, and you have some long-term secular growth trends in your favor.